Okay, so you want to own a movie theater. You picture ticket sales, a packed opening weekend, a line out the door for the next big blockbuster, box office numbers scrolling across a headline. Here's the part almost nobody outside the industry realizes. That ticket you just sold barely belongs to you. For the first 2 to 4 weeks, a major film is out. The studio can take anywhere from 70% up to nearly 100% of every ticket dollar. For a true tentpole release, a Nolan film, a Cameron film, theater chains often surrender the entire opening weeks of box office receipts to the studio before collecting a single dollar of ticket revenue themselves, while still paying for the heating, the cooling, the staff, and the projection equipment during the film's single highest attendance window. So if the movie business barely pays the theater, what does? The answer is sitting in your hand every time you walk in, a $10 tub of popcorn. Here's the real structure of this business. Ticket revenue eventually settles into something closer to a 50-50 split with the studio as a film's run continues past its opening weeks. But concessions are different. 100% of concession revenue stays with the theater, and margins on items like popcorn and soda run upward of 85%. A serving of popcorn costs the theater less than 50 cents to make and gets sold for a markup as high as 1,275%. One veteran theater consultant put it bluntly, "We left the movie business and we're now in the popcorn business." That's not a joke, it's the literal balance sheet. Concessions typically represent only about 20% of a theater's gross revenue, but around 40% of its actual profit. Different chains lean into this to different degrees. Marcus Theaters pulls 44% of total revenue from concessions, Cinemark sits at 39%, and AMC at 36%. And here's the trap hiding underneath all that popcorn math. Despite those extraordinary concession margins, the theater industry as a whole runs an average net profit margin of just around 4%. Why? Because the costs sitting underneath the theater don't scale down when attendance is weak. Rent on a massive multi-screen building, heating and cooling for cavernous auditoriums, staffing, and the constant cycle of technology upgrades, surround sound, stadium seating, 3D and digital projection, laser projectors. All of that gets paid whether the seats are full or empty. This is a business with enormous fixed costs and swing-for-the-fences revenue. And that combination has quietly bankrupted or nearly bankrupted almost every major chain at some point over the last 2 decades. Streaming just made the swings more violent. Let's look at how that trap actually played out at the largest chain in the world. Going into the COVID pandemic, AMC was already carrying roughly $5 billion in long-term debt, which climbed to $6 billion by the end of 2020 as theaters sat closed with zero revenue and the same fixed costs still accruing. AMC survived largely because of an accident of internet culture. The 2021 meme stock rally let the company raise enormous amounts of cash by selling new shares at inflated prices, buying at time it otherwise wouldn't have had. But time bought with equity sales comes at a permanent cost. Since January 2020, AMC has issued over 507 million new shares, diluting existing shareholders dramatically, and by 2025 the company had no authorized shares left to issue. Even after using that cash to pay down debt, AMC still carried roughly $4.5 billion in net debt, and paying interest on that debt cost the company roughly $450 million a year, money that comes directly off the top of operating profit before shareholders ever see a dime. The numbers through 2025 and into 2026 show exactly how brutal that math is. In the third quarter of 2025, AMC posted a net loss of $298.2 million. Largely from non-cash charges tied to yet another debt refinancing, even as its underlying operating margin actually improved to 6.62% and adjusted EBITDA turned positive. Total revenue that quarter came in at $1.3 billion, down slightly from $1.34 billion the year before, with food and beverage revenue falling from $490.4 million to $451.8 million alongside softer admissions. By the first quarter of 2026, things were genuinely improving. Revenue jumped to $1.04 billion, up from $862.5 million a year earlier, and the net loss narrowed to $117 million, down from $202.1 million. CEO Adam Aron has been candid about the trade-offs. The decisions we made were not always popular with our shareholder base, but they were absolutely essential for our survival. That's the honest summary of the AMC story. The operating business is genuinely getting healthier, but it's dragging an enormous debt anchor that eats the improvement before it ever reaches the bottom line. Now look at Cinemark, AMC's largest direct competitor, over that same stretch. Cinemark isn't debt-free. It carries roughly $3.46 billion in total debt against just $447.8 million in equity, a genuinely high leverage ratio on paper. But the operational engine underneath that debt runs meaningfully better. In a strong second quarter of 2025, Cinemark posted $940.5 million in revenue with an 18.72% operating margin, and by the third quarter, the company reported a net margin of 9.13%, a genuine profit, not an accounting loss dressed up as an operational win. Analysts covering the sector have started calling Cinemark the fundamental winner of the theater industry, specifically because of its lower debt-to-EBITDA ratio and higher underlying profitability. The company has been confident enough in that position to authorize a $300 million share buyback program and hike its dividend by 12.5%. The kind of moves a company makes when it trusts its own cash flow, not when it's fighting for survival. Same industry, same pandemic, same streaming pressure, same brutal studio-side ticket split. But one company entered the crisis already over-leveraged and has spent 5 years since then managing debt instead of managing theaters, while the other kept its balance sheet tight enough to keep investing in the actual experience. That gap in discipline compounds every single year it persists. So what actually saved the industry beyond just financial discipline? Premiumization. Both companies figured out that if concessions were the real profit center, the way to grow it wasn't just bigger popcorn buckets. It was making the entire visit worth paying more for. AMC leaned hard into what analysts call a premiumization gambit, restructuring around IMAX, Dolby Cinema, and laser projection auditoriums, and adding full bars under MacGuffin's brand, achieving what one analysis called a 54% higher contribution margin from premium format screens compared to standard ones. It's the same instinct as an airport's duty-free shops or a toll road's captive drivers. Once someone is already inside your building, extract more value from the visit itself rather than just the ticket. AMC even found an unlikely new revenue lane by partnering directly with a streaming rival, hosting a limited theatrical run of Netflix's Stranger Things finale in 2025, proving that streaming and theatrical aren't always enemies if the event is big enough. There's a real lesson buried in that partnership and in the whole premiumization trend. The traditional theater business model, sell a ticket, split it with the studio, hope enough people show up, was never going to survive streaming on its own. What's actually kept these chains alive is the same thing that's kept airports and toll roads alive when their core traffic gets squeezed. Finding the layer of the business the regulator, or in this case the studio, doesn't touch. The studio takes most of the ticket. It takes none of the popcorn, none of the recliner upgrade fee, none of the cocktail at the bar, none of the IMAX surcharge. Every dollar a theater has actually grown over the last 5 years has come from that layer, not from ticket sales. So if you do decide to buy a movie theater, understand what you're actually buying. You're not buying a business that makes money showing movies. The studio makes sure of that. You're buying a building people are willing to sit inside for 2 hours, and your entire job is finding every possible way to sell them something while they're there. The theaters that understood that early and kept their balance sheets disciplined enough to invest in the experience instead of just servicing debt are the ones still standing. The ones that didn't are still fighting 5 years later to convince the market that a good quarter finally means the debt problem is behind them.